Venture capital has long been an exclusive club, funding a narrow demographic while leaving many talented founders on the sidelines. Historically, the majority of investment dollars have flowed toward entrepreneurs who fit a familiar mold, often male, often from elite universities, often part of the same well-established networks. But the tide is shifting. Today, there's a growing recognition that diversity in venture capital isn't just a moral obligation, it's an economic opportunity. A more inclusive venture ecosystem fosters stronger returns as diverse teams consistently outperform homogeneous ones. It unlocks access to untapped markets, driving innovation in ways that traditional funding patterns have overlooked. And perhaps most importantly, it creates a more competitive and resilient startup landscape, one where the best ideas, not just the best connections, receive the capital they need to thrive. But for meaningful change to happen, it's not enough to make surface-level commitments. Venture firms must take deliberate steps to ensure that funding, mentorship, and opportunities are distributed equitably. The first step in that process is understanding the current state of diversity in the industry and why it matters. The statistics paint a stark picture. Women-founded startups receive less than 3% of total VC funding annually. Black and Latinx founders, combined, receive less than 2%. Meanwhile, the decision-makers who control these investment dollars remain overwhelmingly homogeneous. Only 15 to 20% of VC partners are women, and an even smaller percentage come from underrepresented ethnic backgrounds. Much of this disparity stems from how deals are sourced. Venture capital has long relied on warm introductions, connections that flow through existing networks. The problem? Those networks are often insular, making it difficult for outsiders to break in. Without greater inclusion at both the funding and decision-making levels, venture capital risks missing out on high-potential investment opportunities simply because those founders don't have the right connections. The case for diversity isn't just about fairness, it's about results. Study after study has shown that diverse founding teams generate higher returns. Mixed-gender teams, for instance, outperform all-male teams by over 60% in exit valuations. Companies in the top quartile for ethnic and gender diversity are significantly more likely to outperform industry peers in profitability. Beyond financial performance, diversity also drives market innovation. Founders from underrepresented backgrounds often identify and solve problems that traditional investors overlook. They create products and services that cater to underserved communities, opening new revenue streams and expanding market reach. And from a systemic perspective, a more inclusive funding ecosystem mitigates risk. Over-concentrating capital in a narrow subset of founders and industries limits innovation and market resilience. Broadening access to capital ensures that the best ideas, regardless of who they come from, have a fair shot at success. A more inclusive venture capital ecosystem starts by rethinking how deal flow is sourced. Too often, firms rely on warm introductions and referrals from within their own circles, which tend to reflect existing networks and implicit biases. If venture firms want to fund a broader range of founders, they need to look beyond the usual suspects. This means actively seeking out entrepreneurs in overlooked regions, forming partnerships with accelerators and incubators that support minority founders, and organizing open pitch sessions that welcome any founder to apply and be judged solely on the strength of their ideas and execution, not on personal connections. Equally important is the composition of the investment team. Investment decisions are shaped by the people who make them, and when those decision makers come from a narrow range of backgrounds, bias, whether conscious or not, can easily influence outcomes. Firms that are serious about inclusion must prioritize diversity at every level of their organization. This includes recruiting investors from non-traditional backgrounds, hiring more women and people of color, and supporting them through mentorship, sponsorship, and long-term career development. Internal education is also essential, building awareness of bias and embedding inclusive decision-making into the firm's culture and daily operations. Bias is also present in how startups are evaluated. Many firms still rely heavily on pattern recognition, favoring founders who reflect a familiar image of past success. This approach reinforces existing disparities and often excludes highly capable entrepreneurs who may not match traditional expectations. To counter this, Firms should implement structured evaluation criteria that emphasize business fundamentals such as market opportunity, team execution, customer traction, and growth potential. Some firms are experimenting with review processes that conceal the identity of founders during initial assessments, ensuring a more objective and equitable evaluation. Fairness must also extend to the structure of investment terms. Underrepresented founders who do secure funding often face less favorable terms, including lower valuations and more restrictive agreements. Investors must examine their own term sheets and standardize terms that ensure fairness across the board. Finally, real progress depends on transparency and accountability. Unlike public companies, most venture firms do not disclose diversity data about their portfolios or leadership teams. To foster accountability, firms should begin tracking and reporting these metrics. Setting measurable goals for investing in underrepresented founders and inviting limited partners to participate in these discussions can significantly shift capital allocation strategies. When LPs demand transparency and diversity as part of their investment priorities, change becomes not only possible but inevitable. Creating a more equitable venture capital landscape will take time, commitment, and honest self-reflection. But by expanding sourcing networks, building diverse teams, removing bias from evaluations, offering fair terms, and reporting progress publicly, firms can help build an industry that reflects the full range of talent, perspective, and potential found in the entrepreneurial world. While progress is happening, there is still a long way to go. The future of venture capital will be shaped by greater accountability, increased pressure from LPs, and a new generation of investors who view diversity, equity, and inclusion as essential components of their strategy. We are likely to see more demand for diversity reporting from VC firms, corporate-backed initiatives that fund overlooked founders, and the rise of alternative funding models like impact investing. The industry's next evolution will prioritize resilience, innovation, and inclusivity, not just for ethical reasons, but because the firms that embrace this shift will be the ones that thrive. Venture capital must evolve beyond its traditional, insular networks to fund the best ideas, regardless of background. Data proves that diverse teams generate better returns, yet underrepresented founders still receive a fraction of VC funding. To change this, firms must expand deal flow, eliminate bias in investment decisions, and create fairer funding terms. The most successful VCs of the future will be those that embrace diversity not just as a moral imperative, but as a winning investment strategy, ensuring they don't miss out on the next wave of transformative startups.